Good morning, everyone, and welcome to Main Management's weekly market note for the week ended April 24th. I'm James Maxwell, SVP of Research here at Main, joined by...
Alex Dippery, research analyst here at Main.
Just going to go ahead and get started here. Our offerings, as usual, and hopping into the performance year to date and for the trailing week. You had a bit of a rebound in commodities and oil prices during the week. It had some reflaring up of kind of risks in the Middle East, or at least a rebound after coming down kind of the couple weeks prior. Kind of what I've seen is this ceasefire is not going to be as simple as it may have seemed at first glance. Additionally, there's going to be some kind of necessary rebuilding. A lot of the infrastructure that may have been like damaged or otherwise impaired in the Middle East, trying to get that back online is going to take some time. And yeah, more broadly, just kind of risks around that. Obviously, tech actually led on the sector side of things for the week. A big rebound in semiconductors. That's been a huge kind of headline the past almost month, basically since the bottom. They're up over 30% since that bottom. Obviously, that's tied to the AI buildout, kind of broader growth, cyclical parts of the market that are just doing very, very well. Getting into the recession dashboard, nothing has changed here, kind of mostly blue with some green highlights across the board. One of the big headlines last week was Fed chair, or to-be chair, Kevin Warsh's confirmation hearing. And honestly, the actual takeaway from the market was nothing really, was received that well. The overall markets didn't really react. What we actually looked at, what was interesting, was he pointed out two things of kind of his broader term thesis. He thought inflation was closer to 2% than it was to 3%, pointing at what he called, or what is called, the trimmed mean inflation. Basically, what that's doing is taking the highest and lowest underlying parts of inflation and removing them. So if you have a basket of goods, or a basket of goods and services and inflation, you're just cutting off those tails, essentially, looking at the overall kind of underlying trend. It's an alternative to looking at core, which, as a reminder, takes out food and energy. Some economists think that it's kind of a cleaner measure than core, because there are a lot of volatile things in inflation, not just food and energy. There's other things that are volatile month to month. And if you want to look at the underlying trend, that's a way to do it. I think our takeaway is it's a solid measure. It's one of the measures that you probably should look at in terms of inflation. It's not the only measure. And there's also the kind of fact that, if it seems like one of those things, he's looking at it because it's low. Would he have been looking at it if it was high? Hard to say. I mean, you kind of want to, it's almost like he's looking for the data points that support the narrative, which is obviously something that you don't want to do. And then the other thing he mentioned was productivity. And actually, we're big believers in this as well. He kind of believes that productivity is going to allow for economic growth without inflation. And that's really the core thing you want to see, right? Is more output per unit of input, and productivity allows for that. Anything to add to that?
Yeah, I mean, broadly speaking, like you said, trim mean inflation, overall, if you zoom out as a measure, is, a sensible metric. I think right now it's very clear that it's one that would be downwardly biased. And,
Yep.
Even though he's sort of dodged questions directly on rate cuts, it feels pretty clear that he's in favor of lower rates. It seems that way from our point of view, especially given his views on productivity, given his views on sort of reducing the Fed's balance sheet and offsetting that with rate cuts is something he's mentioned before. And so, it's certainly convenient to look at trimmed mean PC.
Yep.
I don't think it means it's not a good measure, but it obviously is one that fits his narrative right now.
Absolutely. Other kind of headline data points we got during the week, retail sales being one of those. It surprised pretty highly to the upside, up 1.66% during the month. That's the highest in quite a while. And even looking under the covers, you had gasoline prices that were kind of leading the charge there, or one of the reasons why it was so high. Just naturally, this reading is not inflation adjusted, so higher gasoline prices are going to mean higher absolute dollars in terms of sales. If you look kind of under the covers, you can really see that gas stations at the top there up 15% month over month, 15.5%. There was some strength still, wasn't the only thing leading. If you look at the core reading, which excludes gas and autos, that was up 65 basis points month over month, above forecasts of 0.2%, and still a strong reading overall, but not as high as the headline might have suggested. Moving to business inventories, another reading we got here was up 0.37% month over month, just ahead of forecasts, and overall doesn't suggest anything too weak. Tied in with the retail sales reading we just got, overall it looks manageable. Pending home sales were up 1.5% month over month in March. That was pretty high above forecasts, which were about 0.5%. And what we're looking at here is obviously the housing market has been in a bit of a depressed state for the past couple of years, high mortgage rates being part of the root of that. One of the notable things is that as mortgage rates moved up during the month, you still had higher pending home sales, which maybe suggests some sort of demand coming off the sidelines. Again, it's 2 months. It's hard to see, how much of a trend that really is. And if you look at the bottom right there, you can really see how depressed the overall index has been. So kind of any rebound is possible. And we'll keep an eye on it to see if there's an actual sustainable trend to come out of this.
Yeah, moving to PMIs, this is, sort of in line with what we've been seeing over the medium term, with a bit of a rebound in manufacturing in the US, but really everywhere. I think this plays well into a broader narrative we're positioning for in our active. A lot of these asset heavier sectors, industrials, materials, energy, all beneficiaries of sort of strength in manufacturing, which has been pretty clearly a trend recently. Within that, one of the regional bed manufacturing indexes ticked down slightly, but sort of zooming out further than that, still part of a broader uptrend. You're seeing strength in really all of those regions, but slight tick down in the Kansas City Fed Manufacturing Index. Overall, still a continuation of that broader uptrend. Going into sentiment here, something we've continued to see has been extremely depressed sentiment, and also in contrast with some of what we've seen earlier, even in this slide, a bit of a gap between soft data and hard data. There's continued to be this divergence there where sentiment remains very depressed, despite really any readings you might see in some of the harder data. So I don't think this is necessarily something that we're reading into too much. If anything, it's probably a strong buying opportunity.
Yeah.
But yeah, still very, very depressed sentiment.
It is crazy. I mean, the reading itself got revised up slightly, but is still the lowest sentiment reading on record all the way back to, I think it's 1955 or so. Through global wars, recessions, financial crisis, everything. Today is seemingly the worst people are feeling in basically since the start of the data.
Yeah, and something a little bit ironic here, sort of comparing, the use of, back to that earlier slide, the use of RIM PCE is that from, the consumer standpoint and what they're feeling, obviously it's very tied to something like gas prices. Inflation expectations are at a very elevated level at 4.7%. And so there is a little bit of a interesting juxtaposition there with what people are feeling and what the perception of inflation is versus what now might be used as the Fed's preferred metric.
I know too, for the Michigan Consumer Sentiment Survey as well, it's particularly sensitive to inflation. So if you look at other things like the Conference Board, Consumer Confidence Index, that also is trying to measure, broadly just consumer kind of confidence or sentiment, that's much more tied closely to the labor market. So during 2022, University of Michigan's readings kind of went way down compared to that Conference Board reading. So kind of important to understand what they're actually measuring. It's just the type of questions that are asked, the overall kind of way that the survey is conducted. makes it more sensitive to inflation. So makes sense, as you were saying, gas prices spiking up, obviously fears of things like, was tariffs last year, now it's oil prices. That all compounds into a worse sentiment reading, specifically for the Michigan survey. Lastly, here on jobless claims, just the weekly report overall have been remaining kind of well behaved. Initial claims ticked up to 214,000, but you can see that they've been trending lower the past, kind of 5 to 6 months, and then continuing claims also been trending lower over time, which is a solid reading for the labor market. Obviously, claims and kind of overall labor market readings are pretty lagging in terms of their kind of forecasting ability. Usually, if the economy is going into any sort of slowdown or recession, that's going to show up last in something like the layoffs or unemployment claims. But still good to see, and it confirms kind of what we've been seeing in the other data. So that's it for this week. Overall, March retail sales beat consensus. A lot of that was driven by gas prices, but even under the covers, things were still strong relative to forecasts. Business inventories were up slightly again above forecasts. March pending home sales were up and beat forecasts as well. That's the second month in a row and highest since mid 2025. PMIs were more positive than negative across the board, and you also saw some of the local or regional Fed surveys also beat their forecasts. And then finally, the consumer sentiment saw a small upward revision, but is still at record lows as inflation expectations and broader inflation remains pressured. For the next week, things we'll be watching are home prices on Tuesday, durable goods, building permits, and housing starts on Wednesday. And then you get Q1 GDP, which should be interesting to see how that comes out. It's the first reading we'll see of that, along with core PC, consumer spending, and employment cost index on Thursday. And then finally, ISM manufacturing on Friday. That's all for this week, and hope you have a good one.